All right, welcome to Chuk Woo's channel. I am Woo. Thank you for tuning in. Today we're going to be talking about treasury bonds. At the end of this video, you'll understand what treasury bonds are, why you should invest in them, and how to buy them, okay? Like, share, and subscribe if you get value from this video. So let's get started. I'll say this as we jump in: most of the terms and the explanations that I offer in this video you can use for bonds in general, but I'm going to be focused on US Treasury bonds here. So what is a treasury bond? Very simple. A treasury bond is a loan that you as an investor give the United States government, okay? They typically last for a set period of time, in this case usually 20 to 30 years. Don't worry about how long that sounds. I'll explain why in a minute. Now, you are the investor. What do you get for making this investment to the United States government? You get two things. One, you get your initial investment, your principal back at the maturity date, which I'll explain in a moment. And you also get something more important, which is the interest payment, right? That's why you're investing in the bond to begin with. You're trying to make money, okay? Now, why does a government or a corporation issue bonds? Simple. The government is like a business. They have actions that they need to take to keep the government running. They have responsibilities that we, the taxpayers, expect them to meet. What are those? They need to repair the roads and the highways, all right? Potholes everywhere. I'm wrecking my rim every other week. They need to fund Social Security. They need to fund the military. To do this, the government needs money. How do they raise money? One of the ways they raise money is by issuing these treasury bonds that you buy. They take in the money from the sales of the treasury bonds and they use it to do what they need to do. It's as simple as that. They use it to raise money, okay? Now, the United States government also issues treasury notes, which are called T-notes, and treasury bills, which are called T-bills. Today's video, like I said, is really about treasury bonds. Now let's get into some specific terms that you will hear when you're thinking about investing in treasury bonds, or you're thinking about learning more about them as you are in this video. I'll say this: like in any other profession, the terms that the professionals use can be confusing. That's called jargon. Doctors use jargon, mechanics use jargon, sports bettors they use jargon. It's the same for understanding bonds. The key thing I'll say is understanding that these terms are not super complicated. You just don't know what they mean yet. That's why I'm going to explain them, okay? So issuer, you'll hear issuer discussed when you're talking about a US Treasury bond or bonds in general. What is that? Simple. In this case, the issuer is the organization, the United States government, that sells you the bond. That's it. They issue the bonds. They are the issuer. Who are you in this transaction? You're buying the bond, you're called the bondholder. That's it. The issuer is the United States government, they're the seller. You are the bondholder, you are the buyer, okay? Next thing you'll hear is called the principal, or the par value, or the face value. You'll hear all three of these terms used interchangeably. Very simple definition again. Principal, par value, face value. That is the amount that the United States government agrees to give back to you at the maturity date, okay? That was your initial investment most of the time. In most of the cases, the face value is called the face value because it's actually written on the bond itself, okay? That's it. It's the amount of money that the government is in contract with you to pay you back at the maturity date. That gets us into our next term, which is the maturity date. Very simple. It's the due date. It's when the government has to give you your initial investment back, right? That's the maturity date. Another term you'll hear is called the coupon rate. Don't worry, again, just jargon. It's just the interest rate. It's how much money the United States government is agreeing to pay you in a periodic fashion. It's twice a year, usually every 6 months, for investing in them, for buying the bond. You're the bondholder, okay? It's usually paid, like I said, semi-annual. It's an interest rate just like an interest rate on a CD, a certificate of deposit, just like an interest rate on your high interest savings account, right? 3%, 4%, 5%. That's all it is. Now, these last two things, they can be a bit confusing. I'm going to try to explain them very simply, right? We talked about issuer, we talked about bondholder, we talked about maturity date, we talked about the coupon rate. The next two things are called the price and the yield. Let's discuss that. What is the price? Most US Treasury bonds have a face value of $1,000, meaning you invest in them in $1,000 increments. Okay, you've got $10,000 bonds, you've invested $10,000. Now, typically, the face value, that $1,000, is exactly what you pay to buy that bond, but not always, right? Sometimes the price you pay for that bond can be different. Why? Let's say it's a very hot bond market. Everyone is interested in buying US Treasury bonds. Government, like I said, they're a business. What do you do when everybody wants your goods or services? You raise the price. So in that case, you have a face value of $1,000 written on the bond, but you have a hot bond market. There are a lot of buyers. The US government can take that $1,000 bond with its $1,000 face value and sell it for more than $1,000, sell it for $1,100. So the price is just the price you pay, right? So that sounds strange, but the price you pay is usually equal to the face value of $1,000, but sometimes it can be higher or it can be lower. That's called the price you pay. Now, what is the yield? The yield is somewhat related to the coupon rate. I said you bought a $1,000 bond, it's paying you a 3% coupon rate. What does that mean? 3% of 1,000, you're making $30 a year. Now, the yield, in that case, the yield is 3%. You're making 3%. But let's say you paid more for that bond. You paid more than the face value of 1,000. You paid $1,100. Your yield, your return on investment is actually lower than the 3% coupon rate. Let me give you a mathematical example. Okay, let's walk through it step by step. You have a bond with a face value of 1,000. You pay 1,000. That means the price you pay and the face value in this example, I'll give you a second example, is the same. It has a coupon rate of 3%. It has a face value of 1,000. The price was 1,000. It has a coupon rate of 3%. That means every year you earn $30. It's paid $15 every 6 months. 15 and 15 is 30. In that case, the yield, how much you make, $30, which is 3% of what you paid, 1,000, is the same. That's example one. Now let's say it's a very hot bond market. You have a bond with $1,000 coupon, $1,000 face value, but the government is selling that bond for $1,100 because everyone wants it. Now, what's the difference here? That means you paid more than the actual face value of the bond. It still has a 3% coupon rate, but what's your yield? Simple math. Your coupon rate on this $1,000 face value bond is $30 a year. It's 3%. You earn $30 a year. But how much did you pay? You paid $1,100. $30 divided by 1,100 gets you like 2.73%. So in this case, your actual yield, your return on investment, is less than the coupon rate because you paid more for the bond up front. You paid $1,100 for a $1,000 bond with a 3% interest rate. Does that make sense? So the long story short here is the more you pay for the bond, the lower your actual return on investment is, the lower your yield. But typically you pay the face value. $1,000 bond, you pay $1,000, 3% coupon rate. Typically your coupon rate and your yield are the same, but not in the hot bond market, okay? So that's the simple explanation of price and yield. Now, why would you invest in it? Why would you invest in a treasury bond? 3 reasons, right? You can invest in crypto, you can invest in stocks, you can invest in real estate, you can invest in a million different things. People choose to invest in treasury bonds. They're safe, right? They're guaranteed by the US government, the full faith and government of the United States, which is written on the bond. They're reliable sources of income. You get the semi-annual payments every year as long as you hold it. Again, we said this bond has a 3% coupon rate. You're getting $15 every 6 months until the maturity date of the bond. And they're liquid. I said at the beginning of the video, US Treasury bonds typically have a maturity date 20 to 30 years in the future. You don't actually have to hold it for 20 to 30 years. You can sell it on the market at any time. So you don't actually have to hold it for 20 to 30 years. And then finally, it leads to a more diversified portfolio, right? You have some crypto holdings, you have some equities, you have some corporate bonds, you have some US Treasury bonds. Generally speaking, this is not financial advice, but generally speaking, it's always healthier and more prudent, wiser to have a very diverse portfolio. How do you buy one? treasurydirect.gov. You go there, you create an account, you link your bank account, and you buy them. The good news is, in most examples, I said the face value of a bond is $1,000, but you can buy them actually in increments of $100 on treasurydirect.gov, okay? So that's today's video. You understand now, hopefully, what a US Treasury bond is, the definitions associated with it, why they're issued, and then why you might want to invest in them and how to buy them. Again, thank you for tuning in to Chukwu's channel. You got any value from this, please like, share, and subscribe. We'll talk to you later. See you.